Let's look at some more business transactions now. On our slide, it says on November the 30th, dividends of $2,000 were paid. And we're paying these in cash. So notice that cash is going to go down. It is going to go down with a credit. That means that the other side of that, dividends, goes up with a debit. Now, dividends are not an expense. Dividends are not an asset. They are merely the flip side of the transaction when an asset goes down. So because cash is going down and we use a credit, dividends go up with a debit by default. Looking at the accounting equation here, assets have most definitely gone down. That's why we have $2,000 here over on the right side of our little T account. And dividends have gone up. But I want you to understand that as dividends go up, stockholders' equity goes down. Okay, because this $2,000, before we distributed it to an owner, it was a part of retained earnings. Those earnings have now no longer been retained. So don't get confused. When it says increase here, we're referring to the dividends account. The stockholders' equity account has actually gone down. Okay. All right. So we've looked at this slide before, and it says posting journal entries to accounts. It says the process of transferring the debits and credits from the journal entries to the accounts is called posting. So the first thing that we would have done actually is to analyze a business transaction. Then we would record these journal entries and then we will post them. Now I want you to understand, if you're wondering, okay, well, what's the difference between recording a journal entry and posting entries to the ledger? I would think about it like this. Use an email as an example. When we record the journal entries, we're typing out the email. When we actually hit send, that's going to automatically post those entries to the various ledger accounts. So this process here of posting in modern times is simply clicking a button, an enter button, something like that, or a done button, those types of things. Not a big deal. All right. So, continuing on, posting journal entries to accounts, it says on December the 1st, this is the next month, Net Solutions paid a premium of $2,400 for an insurance policy for liability, theft, and fire. The policy covers a 1-year period. Okay, so what we have here is we're swapping out one asset for another. We had cash of $2,400 that we let go of. We spent it. And we get a prepaid expense asset. So I want you to understand that when we say prepaid expense, we're talking about any type of prepaid expense. When we say prepaid insurance is an example of a prepaid expense. So let's see what it says here. The policy covers a 1-year period, so it looks like we're being charged $200 per month. And so we outlay the cash here, $2,400. We get a prepaid asset. Now this asset is going to go down by $200 each month that we have it. Accounting equation impact, there is no impact because we've simply swapped out cash for prepaid insurance. We'll actually expense this as each month passes. Here we have a situation which is a little bit different. It says on December the 1st, Net Solutions paid rent for December of $800. The company from which Net Solutions is renting its office space now requires the payment of rent on the 1st of each month rather than at the end of the month, and that's going to almost always be the case. Again, I want you to understand what these numbers here are, in that they're not very important. These are just the account numbers for cash and for rent expense. Okay? So if you were wondering about that, now you know. What do we have here? The impact on owner's equity is, well, it's going to go down because we have reduced assets, but we haven't reduced any liabilities. So when an asset is reduced and there's no corresponding reduction to liabilities, stockholders' equity, in fact, does go down. Okay? Well, let's see here. What's going on? All right. Now we have another transaction, paid for an advertisement. On December the 6th, Net Solutions paid $180 for a newspaper advertisement. Doesn't look like we have an account for advertising expense, so we're just going to call this miscellaneous expense. Again, cash goes down because we paid for it, so we have to credit cash over here to the right. The expense is the debit. This has the exact same impact on owner's equity, or on the accounting equation, as the previous transaction, because they're both expenses and we haven't reduced any liabilities. All right, let me make sure we're on the right slide here. Okay, we're good. Paid creditors on December the 11th. Net Solutions paid creditors $400. Okay, so what is this? This is that remaining $400 that Net Solutions owed for those supplies that they had purchased. That's what this is. So we're going to debit the account payable, because if we don't, this is how we get rid of it. We set up liabilities with credits, and then we get rid of those liabilities with a debit over here to the left. Cash has gone down. It's an asset. It's gone down, so we're going to credit cash. What is the accounting equation impact? There actually is not any, because we have reduced assets by $400, but we've also reduced liabilities by a corresponding $400. Now, I want to say something really quick here. I know this might be getting a little bit tedious for some of you who are watching this, but that's okay. I'm doing that on purpose. I'm trying to kind of drill this into your head, because the more times you see it, the more it becomes automatic. I want this to be, I hate to say it, but I kind of want this to be boring for you. I want it to be get to the point where it's so easy for you that it's boring. All right, let's continue. All right, transaction fees received on December the 16th. It says on December the 16th, Net Solutions received $3,100 from fees earned for the first half of December. Okay, so maybe they had a project that took place over December 1st through December the 15th. I'm not real sure. But they completed that, and then just like the previous transaction where they got $7,500, we have the exact same thing happening here, except it's only for $3,100. And so we're going to go ahead and debit cash $3,100. Fees earned, our revenue account, is the credit. Okay, that's over on the income statement for $3,100. This again is the kind of transaction that we want to see. Assets go up, liabilities don't go up. That means stockholders' equity also goes up. I'm going to go back to slide 36 for a moment. I accidentally skipped this one. That's okay. The fact that we're not doing it in order is fine. We'll just skip to 38 after this. Transaction paid wages on December the 13th. They paid a receptionist and a part-time assistant $950 for 2 weeks wages. So it looks like as soon as the 2 weeks were completed, they went ahead and paid them. That's not how it normally works in the real world. Usually you work for 2 weeks, and then 2 weeks after that, you get paid for the 2 weeks that you just worked. But I guess they're being nice. And so what do we have? We have cash going down here in the amount of $950. That's our credit. Wage expense goes up with a debit. All expenses go up with a debit. Accounting equation impact. Well, expense here goes up, but again, stockholders' equity goes down. And then, of course, cash goes down as well. All right, let's see. We did this transaction here. Okay. Let's talk a little bit about accounts receivable. It says fees earned, sales on account. It says when a business agrees that a customer may pay for services provided at a later date, an account receivable is created. So we provide the services and then the payment is going to come at a later date. And just as we discussed in Chapter 1, an account receivable is a claim against that customer. So an account receivable is most definitely an asset. And the revenue is earned even though no cash has been received. Why? Because we're dealing with the accrual basis of accounting. Okay? If we had to wait until cash was received, we would be dealing with the cash basis of accounting, and that is not a U.S. GAAP approved method of accounting. So we're going to go with the accrual basis of accounting. Let's go ahead and do this little transaction here, and then we will stop this video. It says fees earned on account. Fees earned on account totaled $1,750 for the first half of December. That may be from one customer, maybe from 5, we don't know. But we know that they didn't get the money up front. So what we do is we debit another asset account instead of cash called accounts receivable for the $1,750. The entry to revenue or fees earned is the exact same as it would be if we had actually received the cash. There is no difference. The accounting equation impact, assets have gone up. Accounts receivable is an asset. We have not incurred any liabilities, therefore stockholders' equity goes up as well. All right, let's go ahead and wrap this video up, and we'll get another one started after this.